Ryan makes $72,000 a year as a project manager in Columbus, Ohio. After taxes, his take-home is around $4,600 a month. He drives a used Honda, packs his lunch most days, and has been investing since he was 27. Nothing dramatic about Ryan's story, and that's exactly the point. Last spring, Ryan sat down with a spreadsheet and did something most people never bother to do. He stopped thinking about his investment portfolio as a number and started thinking about it as a paycheck. A second paycheck. One that showed up every single day, whether he went to work or not. Here's what he found. His portfolio at the time was worth $147,000, invested entirely in low-cost index funds. At a historical average return of 8% annually, that portfolio was generating roughly $11,760 per year in wealth. Break that down. $980 per month, $32 per day. Every day, including the days he called in sick, the days he took his kids to the beach, and every Saturday morning he slept in. His daily take-home from his job? Around $153 after taxes and expenses. His portfolio's daily output? $32? The ratio was roughly 1 to 5, and his job was still winning by a mile. But Ryan did one more thing. He projected forward. He asked, at what point does that $32 per day become $153 per day? At what point does the portfolio's daily paycheck match, then beat, what his employer pays him? That question has a specific, calculable answer. And the math behind it is what we're exploring today. Most people check their investment account like they check the weather, occasionally, with vague anxiety, and no real framework for what the number means. Ryan's approach was different. He made the abstract concrete. He gave his portfolio a daily wage, and once you see money that way, you can't unsee it. This is the story of how ordinary people reach the moment their investments stop being a safety net and start being a replacement income. It's not a story about luck, inheritance, or getting in early on the right stock. It's a story about arithmetic. Passion, compounding, inevitable arithmetic. My name is Ryan, and yes, the story I just told you is based on my own spreadsheet from about 2 years ago. I'm not a financial advisor. I don't manage anyone's money but my own. What I am is someone who got genuinely obsessed with the mechanics of how wealth compounds, not the motivational version of that story, but the actual math, the specific thresholds, the psychological phases people go through, the variables that most personal finance content glosses over. I've spent hundreds of hours reading academic research on retirement portfolios, safe withdrawal rates, and the behavioral patterns of people who actually reach financial independence versus the ones who earn plenty and end up with nothing. If you're the kind of person who wants to understand the engine, not just hear that engines exist, hit subscribe. That's who I'm making this content for. And if you've got 3 minutes to spare after this video, open your investment account and calculate your portfolio's daily wage using the formula I'm about to give you. It will change how you think about every financial decision you make going forward. Here's what this video is going to do. By the time we're done, you'll know how to calculate your portfolio's daily wage right now. Not some abstract future projection, but your actual current number. You'll understand the 3-phase arc of wealth building that every investor goes through, and you'll be able to identify which phase you're in today. You'll learn the single variable that research consistently shows matters more than investment returns in determining how fast you reach financial independence, and you'll walk away with a specific date, your crossover date. The point at which your passive income is projected to match your take-home pay. I want to be upfront. This is not a video about getting rich fast. The math I'm going to show you is slow, reliable, and backed by a century of market data. There are no shortcuts being sold here. What I'm offering is clarity, a framework for seeing exactly where you stand and exactly what it takes to reach the moment your money works as hard as you do. Let me introduce the core concept. And I want to frame it in a way that's different from how you've probably heard it before. Most financial independence content talks about passive income as if it's a destination, something you reach after years of effort and then get to enjoy. I want you to think about it differently. Passive income isn't a destination. It's a rate. It's a competing salary. And right now, whether you have $5,000 invested or $500,000, that competing salary exists. It's just very small for most people. Your financial life runs on two parallel income streams. The first is your active income, the salary, the wages, the freelance check. This stream requires your presence. The moment you stop showing up, it stops. It's also fundamentally constrained. There are 24 hours in a day, and someone is only willing to pay you so much per hour. Real wage growth in the United States, as tracked by the Bureau of Labor Statistics, has averaged roughly 1% to 2% annually after inflation over the past decade. Some years, it's better. Some years, wages have declined in real terms, but the ceiling is structural. You are one person. The second stream is your investment income, the return generated by capital you've already deployed. Dividends, interest, appreciation in a broad index fund. This stream has no ceiling. It doesn't require your presence. It doesn't get sick. It doesn't take vacations, and unlike your salary, which compounds only when you negotiate a raise, investment income compounds automatically with every passing year. Here's the thing about these two streams. They're on a collision course. Your salary grows slowly, linearly, and with friction, your investment income grows exponentially. Slowly at first, nearly invisibly, and then with increasing acceleration as the compounding base expands. The moment those two lines intersect, the moment your daily investment income matches your daily take-home pay, I call that the wage inversion. It's the day the arithmetic of your life formally flips. After that point, your capital is generating more for you than your employer is. Work doesn't stop being worthwhile, but it becomes optional in a way it never was before. The concept has roots in Vicki Robin and Joe Dominguez's 1992 book, Your Money or Your Life, where it was called the crossover point. I prefer wage inversion because it emphasizes what's actually happening. The power relationship between you and your employer has inverted. Your portfolio is the new employer. Your job is the side hustle. The only question is when this happens. And unlike most important questions in life, this one has a calculable answer. Let's get into the numbers, because this is where it gets real. Ryan's situation, $147,000 invested, generating $32 per day at an 8% annual return assumption, is a useful starting point. But to find his wage inversion date, he needed to know two additional things: his actual monthly take-home pay and his actual monthly expenses. Monthly take-home, $4,600. Monthly expenses, $3,400. He tracked 3 months of bank statements to arrive at this number. Not an estimate, but the actual figure. That $3,400 monthly in expenses translates to a crossover number of $1,020,000. Using the 4% safe withdrawal rate, which means multiplying annual expenses by 25, Ryan needs his portfolio to reach $1.02 million before his investment income can sustainably cover his lifestyle indefinitely. At his current investment rate of $900 per month, roughly 20% of his gross income, and assuming 8% average annual returns, Ryan will reach $1.02 million in approximately 19 more years. At age 51. Now, here's where it gets interesting. 3 variables control how fast he gets there, and they don't contribute equally. Variable 1, savings rate. Research from financial planner Michael Kitces, who has written extensively on retirement income planning, and from the broader FIRE movement, consistently shows that savings rate is the single most powerful lever in the timeline. A person saving 50% of their income reaches financial independence in roughly 17 years, regardless of their absolute income level. Based on modeling that assumes average market returns, a person saving 10% needs closer to 43 years. Same market. Dramatically different outcomes. Variable 2, expense level. This one operates on both sides of the equation simultaneously. Lower expenses mean more money available to invest and a smaller crossover number to hit. If Ryan cuts his monthly expenses from $3,400 to $2,700, his crossover number drops from $1,020,000 to $810,000. That's $210,000 less he needs to accumulate. At his current investment rate, that single change shaves roughly 4 years off his timeline. Variable 3, investment cost drag. This is the one most people ignore, and it's a significant mistake. The S&P SPIVA report, published annually by S&P Global, has consistently documented for over 2 decades that the vast majority of actively managed funds underperform their benchmark index over 10-year or longer periods. The cost difference between a broadly diversified index fund, which can carry an expense ratio as low as 0.03% annually from providers like Vanguard or Fidelity, and an actively managed fund charging 1% or more, is not trivial. On a $500,000 portfolio held for 20 years, the difference in fees alone compounds to roughly $200,000 in final portfolio value. That's the cost of a house in many parts of the country. Quietly extracted by fund expenses over 2 decades. Back to Ryan. If he does only one thing, drops his monthly expenses by $700 and redirects that to his investment account, taking him from $900 to $1,600 invested per month, his wage inversion date moves from age 51 to approximately age 45, 6 years of freedom, purchased by one deliberate lifestyle decision. There are 3 levers available to anyone trying to accelerate their wage inversion date. I want to be specific about the sequence in which they should be applied, because the order matters more than most people realize. Lever 1, reduce the drag. Before you try to earn more or invest more, audit what you're already doing. Ryan found, when he went through 3 months of actual bank statements, that he was spending $340 per month on subscriptions he'd forgotten about, streaming services, a gym membership he used twice, an app subscription from 3 years ago. That's $4,080 per year, leaving his account with essentially 0 return on life satisfaction. Eliminating drag costs nothing except attention. It also carries a compounding bonus. Every $100 per month in reduced expenses cuts $30,000 from your crossover number at a 4% withdrawal rate, while simultaneously adding $100 per month to your investable income. That double leverage makes expense reduction the highest return move available. Lever 2. Increase the rate once drag is minimized. The next priority is increasing how much you invest each month. This doesn't require a dramatic income increase, though that helps. It can come from renegotiating a bill, picking up a project on the side, or redirecting a raise rather than spending it. The critical discipline here is what behavioral economists call savings rate automaticity. Setting your investment contribution to auto-transfer the day after your paycheck lands. Before your brain registers the money as available, studies in behavioral finance, including research by Shlomo Benartzi and Richard Thaler on the Save More Tomorrow program, have shown that automatic contribution increases tied to raises can dramatically improve long-term savings outcomes without people experiencing the psychological pain of deprivation, the money you never see. You don't miss. Lever 3. Extend the runway. This lever is less about action and more about patience, and about not sabotaging the compounding curve at key moments. The most common self-inflicted wound Ryan sees among people in his network is panic selling during market downturns. The S&P 500 declined approximately 34% between February and March 2020 during the initial COVID-19 market shock. By August 2020, it had fully recovered to pre-crash levels. Investors who held through the decline and continued contributing captured the full recovery. Investors who sold at the bottom locked in permanent losses. The math of compounding only works if you stay invested through the turbulence. Extending the runway means committing to the timeline even when, especially when, the market makes it emotionally uncomfortable. One more concept worth understanding. Cost-FI. This is the point at which you've invested enough that, even if you never add another dollar, compound interest alone will grow your portfolio to your crossover number by a target retirement age. For Ryan at 32, with $147,000 invested and a crossover number of $1,020,000, the Cost-FI calculation at 8% over 30 years means he would need approximately $101,000 to be already at Cost-FI, and he's past that. His retirement is, in a mathematical sense, already locked in. He doesn't have to keep investing aggressively. He chooses to because it moves the date earlier. The math is the easy part. The psychology is where people either follow through or don't. Ryan's experience follows a pattern I've seen repeated in virtually every account I've read or heard from people who've reached financial independence. There are 3 distinct psychological phases, and each one requires a different approach to stay on track. Phase 1 is what I call the invisible phase. This covers roughly the first 3 to 5 years of serious investing, or until the portfolio reaches somewhere between $50,000 and $100,000. During this phase, the compounding is technically happening, but it's nearly impossible to feel a good year might add $6,000 to an $80,000 portfolio. That feels like a rounding error when your mortgage is $2,200 a month. The market drops 12% in a correction, and suddenly your portfolio balance looks worse than when you started the year. Even though you've been contributing diligently, this is the phase where motivation fails almost everyone who relies on it. The antidote isn't discipline in the motivational sense. It's removing the decision entirely. Automate the contribution. Automate the investment. Stop checking the balance more than once a quarter. The invisible phase demands structural solutions, not emotional willpower. Phase 2 is the momentum phase. For most investors, this kicks in somewhere between $100,000 and $250,000. The math starts to become viscerally real. A 10% return on $200,000 is $20,000, and that's a meaningful number. Market volatility starts to look less like a threat and more like the natural weather of the system. Ryan told me that crossing $150,000 was the first time he genuinely felt compound interest working. He could see the curve bending. He stopped checking his portfolio out of anxiety and started checking it out of curiosity. His relationship with his job shifted subtly, but unmistakably. He started negotiating differently. He turned down a project that would have required significant overtime because the financial cushion gave him the confidence to say no to things that didn't serve him. He wasn't financially independent, but he had options. Phase 3 is the inversion phase, the final stretch leading up to and beyond the wage inversion date. By this point, portfolio income is covering a meaningful portion of monthly expenses. For Ryan, when his investment income reached $1,500 per month, it was covering nearly half his living expenses. The psychological effect of this is hard to overstate. When your portfolio is paying your grocery bill, your car payment, and your utilities, your relationship with employment changes at a deep level. You're no longer trading time for survival. You're choosing to work. That's a different posture entirely. And most people who experience it report that they actually become better at their jobs because the desperation is gone. Let me deal with the 3 objections I hear most often, because they deserve real answers. Objection 1. The stock market is too risky. What if it crashes and never comes back? I take this seriously because it's not an unreasonable fear. Let me offer some context. The S&P 500 has experienced numerous major declines over the past century, including the Great Depression, the 1987 Black Monday crash, the dot-com collapse, the 2008 financial crisis, and the 2020 pandemic crash. In every single case, the market eventually recovered and went on to reach new highs. The 2008 to 2009 financial crisis saw the S&P 500 lose approximately 57% of its value from peak to trough. By 2013, it had fully recovered. By 2020, it had more than doubled from its 2009 low. The scenario in which the stock market crashes and never recovers is effectively a scenario in which the entire U.S. corporate economy fails permanently. If that happens, no asset class is safe. Not real estate, not bonds, not cash. The relevant question isn't whether crashes happen. They do. Regularly. Predictably. The question is whether the long-term trajectory holds. Over any 20-year period in the history of the U.S. stock market, the market has been positive. Every single one. That's not a guarantee of the future, but it's the most robust data set we have. Objection 2. I have student loans and credit card debt. I can't afford to invest. This is a real constraint, and the right answer depends entirely on the interest rates involved. High-interest consumer debt, credit cards, which commonly carry rates between 20 and 27% annually, should almost always be eliminated before investing in equities. No broad market index fund reliably returns 20% per year. Paying off a 24% interest credit card is a guaranteed 24% return. It's the best investment available in that situation. Once high-interest debt is gone, the calculation shifts. Federal student loans at 4 to 6% are genuinely ambiguous, the case for carrying them alongside investing, particularly if you have access to an employer-matched retirement account, is mathematically sound. An employer match of 50% on your first 6% of salary contribution is a guaranteed 50% return on that portion of your investment, which almost certainly exceeds the interest rate on low to moderate student loan debt. Objection 3. I'm 44. I started late. Is this even relevant to me? Yes. And here's why. Compound interest is time sensitive, which is why starting early matters. But late is relative. A 44-year-old who invests $2,000 per month at 8% annual returns for 21 years, reaching age 65, accumulates approximately $1,350,000 at a 4% withdrawal rate. That portfolio generates $54,000 per year in investment income. The average Social Security retirement benefit in the United States in 2024 was approximately $1,907 per month, or about $22,884 annually. According to the Social Security Administration, someone who builds a $1,350,000 portfolio has created investment income more than double the average Social Security benefit from a portfolio they own and can pass on. Starting at 44 doesn't mean starting irrelevant. It means starting with more urgency and, usually, a higher income to leverage. Here are 5 concrete steps, in the order Ryan recommends doing them. Not suggestions, but a sequence. Step 1. Calculate your portfolio's daily wage. Open your investment account right now. Find your total balance. Multiply it by 0.08. Divide that number by 365. That's what your portfolio earned today, on average, in wealth generation. Write it down. Put it somewhere, you'll see it. This number is your score. It changes the way every financial decision feels. Step 2. Find your real monthly expenses. Not what you think you spend, but what you actually spend. Pull 3 months of bank statements and credit card statements and add up every outgoing dollar. Most people discover they're spending 15 to 20% more than their mental estimate. That gap is where your acceleration lives. Step 3. Calculate your crossover number. Take your actual monthly expenses. Multiply by 12. Multiply by 25. That's the portfolio size at which your investment income, at a 4% withdrawal rate, covers your lifestyle indefinitely. Subtract your current portfolio balance. That's the gap. Step 4. Run your wage inversion date. Use any free compound interest calculator online. Input your current balance, your monthly investment amount, and 8% annual return. Find the year when your portfolio balance equals your crossover number. Mark that year in your calendar. Give it a name. It's a real date that represents a real threshold in your life. Step 5. Find your single highest leverage move. Look at your monthly expenses and ask, what is the one change that would have the largest combined impact, both reducing my crossover number and increasing my monthly investment? For Ryan, it was canceling subscriptions and redirecting that money to his index fund. For someone else, it might be refinancing, downsizing, or eliminating a car payment. Find yours. Do it this week, not someday. Here's a reframe that Ryan uses when he's tempted to make a large discretionary purchase, and I think it's the most useful mental model in this entire video. Every financial decision has 2 prices, the sticker price and the inversion cost. The sticker price is obvious. It's the number on the receipt. The inversion cost is what that decision does to your wage inversion date. It has 2 components, the compounding return you give up on the money spent and the increase in your crossover. Number, if the purchase increases your ongoing expenses. Here's a concrete example. Ryan was considering upgrading his apartment, moving from a place costing $1,200 per month to one costing $1,700 per month. The $500 difference seems manageable. But let's look at the inversion cost. First, the crossover number impact. $500 more per month is $6,000 more per year in expenses at a 4% withdrawal rate that requires $150,000 more in portfolio value to sustain. Ryan just added $150,000 to his finish line. Second, the compounding impact. $500 per month, not invested over 15 years at 8% annual returns, compounds to approximately $173,000 in lost portfolio growth. Total inversion cost of that apartment upgrade, roughly $323,000, and between 2 and 4 years added to his wage inversion timeline, Ryan kept his apartment. This is not a framework for deprivation. Ryan still takes vacations, still eats at restaurants, still spends money on things that genuinely improve his life. The framework is about visibility, making the true exchange rate legible so you can decide with open eyes whether something is worth its full price, not just its sticker price. The wage inversion is coming for everyone who invests consistently. The only variable is when, and every decision you make between now and then either moves that date closer or pushes it further away. Understanding which direction a given choice pushes you is the most financially valuable skill you can develop. So here's what I want you to do tonight. Not this weekend. Tonight, open your investment account. Do the daily wage calculation. Balance times 0.08 divided by 365. Write that number down somewhere, you'll see it tomorrow morning. If the number surprises you, if it's larger than you expected, that's a good thing. It means compounding has already been working for you, quietly, without your supervision. If it's smaller than you'd like, that's useful information too. It tells you exactly what you're building toward. Ryan checks his portfolio's daily wage every Monday morning with his coffee. Not with anxiety, with interest. The way you track any project you're genuinely invested in. It took him about 18 months to go from viewing his investment account as a distant retirement abstraction to seeing it as a functioning, compounding, income-generating engine that runs parallel to his career. That shift in perspective is available to you right now. You don't need more money to start. You need a different way of looking at the money that's already working. Next week, I'm going to walk through the specific account structure that maximizes how quickly an American working household reaches the wage inversion, the right order of operations between your 401k, Roth IRA, and taxable brokerage account based on your income level and timeline. The sequencing here is genuinely consequential, and most people get it wrong in ways that cost them years. If this video reframes something for you, hit the like button. It's the clearest signal I get that this kind of content is worth making more of. And subscribe so you don't miss next week. I'll see you then.